Do you actually understand what I'm saying when I show you my price charts? Do you understand the psychology behind a Japanese candlestick? If this is all alien to you, by the end of this video, I promise you're going to have a greater understanding of the crypto markets and how to read price charts. 2024 on this channel is going to be a year for learning, and we're going to do it together. Now, the first thing that you should do if you are new to cryptocurrency and you're looking at trading is understand the psychology behind a Japanese candlestick. What is a Japanese candlestick, and how can you identify a weak candlestick, a neutral candlestick, or a strong candlestick? Because there can be bullish candlesticks that are actually bearish and bearish candlesticks that are actually bullish. And I'm going to show you exactly what I mean very shortly with that. But firstly, the Japanese candlestick, it's made up of 4 key components. This is the key components. It's the open. In this instance, it's the bullish candle, so it's the open, and price is trading higher. And that's represented by this green body here. So that's the body, and we've got the extreme highs and the extreme lows of the session. So if you trade in the daily time frame, each one of these candles would represent 1 day of price action. So during that time, the bulls have managed to push price right to the top of the extreme high here, and they've closed it a little bit further down. Bears have got a little bit of momentum here. They've pushed the bulls back down. So this is a pretty strong green bullish candle, but you've also had this here. So you've opened the candle here, and the bears at some point during the session have actually made this candle red, and that's represented by the extreme low of this wick. So the bears have had some kind of momentum. They've tried to push price action down, but you see the bulls have bought back up, the buyers have bought back up, and the candle has closed here. Same for the bearish, apart from this is the open. So it's a red candle. It means it's closed lower than the open. And it's also got extreme highs, and it's also got extreme lows. So we can tell the same story with this bearish candle as the bullish candle. At some point, the bulls have managed to push price action right to the top. This candle would have been green at the time. And then the bears have regained momentum, pushed price action back down, tried to push back to the extreme low represented by this wick, but then the bulls have pushed it back to the close of the body here. So that's 2 different versions of a Japanese candlestick. It's a bullish and it's a bearish, and this is how you can identify whether something's strong or weak. Now we're going to look at 4 different versions of bullish candlesticks. What we're going to do is look at the 4 different versions, and then I'm going to show you how to identify a trend, so you know that you're swimming with the money, you know you're flowing with the whales. That's the important thing. We're not going to be swimming against the current. We're going to be flowing with the rest of the money flow. So we're going to identify the trend, and we're going to work out how these candlesticks react at structure, support, and resistance. That's a powerful thing, and that's something that I'm going to keep drilling and drilling and drilling until it makes sense with you guys. So if none of this does make sense, hit me in the comments and I'll help you. I promise that. So we've got the green candlestick here. Remember, with a green candlestick, it opens above the open of the day. So this is a session, this is the 1 day, and it's opened green above and it's closed up here. So what does this wick tell us? It's a little wick, it's an extreme high. It means the bulls have pushed price action to the top of this wick at some point during this session, but at no point, there's no wick at the bottom here, the bears have pushed price action below the open. So that's a strong bullish candle. This second one's a pretty strong bullish candle. We've got no wick at the bottom, so the bears haven't had any momentum during the session. However, the bulls have pushed price action right to the top of this wick, and the bears have regained a little bit of momentum by pushing price action back down, and this is where the candle ended up closing. So the third one, it's a bullish candlestick. This is the open, this is the close. However, it's a bullish but bearish candlestick, because you can see that the bulls have pushed price action right to the top here, and the bears have slammed it back down. Bears haven't managed to regain full momentum and make this candle red, which it would be if it closed below the open, but they've regained some form of momentum. So that is a strong sign that the bears have regained some kind of selling pressure here. And if this was at structure resistance, you'd see that that's telling you that there's going to be some kind of reversal likely. Now, the third candlestick, this is what we call a doji candlestick, and it's more of an indecision candlestick, because we've got the open, you've got the close. So that's represented by this body here. However, the bulls at some point have pushed price action right to the top here, and the bears have pushed it all the way down to the extreme low of this point, and then the bulls have pushed it right back up. So that's showing indecision. During that session, the bulls and the bears have both regained some form of buying and selling pressure, and there's indecision here. So if this is at a structure support, you'd be looking to to see what the next candle shows. If it's a bullish candle and it's a strong momentum candle that closes above the extreme high of this candle, that's showing you that the bulls are regaining their buying pressure. The bulls are regaining momentum, and that's looking like price is moving higher. So that's what you can get from the bullish ones. And we can do exactly the same for the bearish. We know that price has opened here. The bears have pushed price action all the way to the extreme low. The extreme low is actually the close of this body, which is even a stronger bearish candle. There's no wicks down here. No wicks up here. So that's as strong as it gets as far as the bears are concerned. Same again here, guys. There's your open. There's your close. At some point, the bulls have pushed price action all the way to the top of this level here, and the bears have slammed them back down with a close of this body. So that's a pretty bullish candle, but it shows that the bears in this instance, or the bulls in this instance, have regained a little bit of momentum. Same again here. There's the open. There's the close. Bulls have pushed price action all the way here. Bears have slammed them back down again. And then you've got the same with the indecision doji candle. It's exactly the bullish scenario. So what we're going to do now is we're going to show you how to identify a trend, how you can use the trend to your advantage. The trend is your friend until the bend at the end, and I'm going to show you why. And I'm going to make this as simple as possible, because trading doesn't need to be difficult. It can be easy. The easier that your rules are, the easier that your strategy is, the more chance you have got of following it. So what we're going to do is we're going to go over how to identify the three different types of trend: the bullish trend, the bearish trend, and the sideways trend. So they all give us a clear picture as to where we need to enter into the market. So firstly, you've got your bullish. You're making a series of higher highs. You're making a series of higher lows. Higher highs, higher lows. Higher highs, it's as simple as this: higher lows. That's your bullish trend. And what's happening once you're making those series of higher lows and higher highs, you're creating structure, support, or resistance, depending on what trend that you're in. So you'd add in a trend line here, and this is going to act as support going forward. So it's come back down, it's acted as support. The bulls have taken out this previous high, creating a new higher high, and then created a new base level of structure. So what acts as previous resistance, once broken, should flip support. So if you're in a bullish trend, this previous resistance is going to come back and it's going to act as support. When do you know that you're wrong in a bullish trend? It's when you take out the previous higher low and create that lower low. Once you've created the lower low, the trend is likely to reverse and start creating those series of higher lows and lower lows. So that's the bullish trend. That's how you can identify when a bullish trend is finished. And we'll do exactly the same for a bearish trend. So you're starting at the top left of the screen in a bearish trend. You're making a series of lower lows, as we say, lower highs, lower lows, lower highs, and lower lows. So we're creating our structure previous support, which is now acting as resistance going forward. So what that does is it allows us to know where we expect price to react. If we're in a bearish trend, we've come back, we've tested our previous structure, what was support, we expect it to become resistance, and then we expect price to continue with the trend. That's why we swim with the whales, and that's why the trend is your friend till the bend at the end. Now, sideways action. Everyone hates sideways action. You have your crypto springs, you have your crypto summers, you have your crypto winters, but there's a bit in between, and it's a high time frame in between where the market's undecided. You created a base and you're going sideways, and what's happening is the bulls are looking to accumulate at lower levels to position themselves for the next run. That's where the institutions get in. That's where the big money gets in. So when you're creating a sideways range, it looks like this. It's never just up and down. Looks like it's created a higher low. Bam. This is what you get, just complete choppiness, and this completely wrecks everyone. But there's one thing that you can do. If you're a sideways range trader and you're looking to take advantage of this, they're not usually big moves like bullish trends or bearish trends, but you can create a range. When you create the range, you can tell when a market's overbought, when a market's oversold, and when it's likely to react at these support and resistance levels. So you expect it to act at these resistance levels here, and you expect it to act at the support levels here. So you can get an edge in a sideways market, but it's very choppy, and it does completely wreck you. It's designed to wreck you, so it is a difficult one to learn. So I would stick with the trend. like I say, it can be your friend. So let's have a quick look at the Dogecoin chart. We'll put in our support and resistance, and we'll look at how the candlesticks react at those support and resistance, and see if we can get a story of what price is likely to do going forward. And we're going to put it all into practice now on the Dogecoin chart. The chart is just, remember guys, a chart of human emotions. Sometimes people are happy, sometimes people are sad, sometimes people are greedy, sometimes people are fearful, and we can tell how they felt by looking at the charts. So in this instance on the Dogecoin chart, we're going to start right back from November 2021, and we know that the bears regain momentum. How do we know? Because you can see they're putting in a series of lower lows and lower highs. So we know we're bearish. We know that it's trading from the top left to the bottom right. We're in a bearish trend. So if we're in a bearish trend and we're looking at flow with the money, you're looking for sell orders. And where would you be looking for sell orders? At resistance. So look how price reacted at this resistance level. And remember, it's a story. Candles opened here. The bulls have pushed price action right up to the diagonal trend. It's been rejected at that level, and it's come back down and closed below this resistance point. So this has acted as resistance. The bears have pushed price action below this resistance, which was previous support, made a lower high, pushed price action back down, and you can see how price is reacting at these resistance levels. Look at the wicks here. Each one of these is a wick. So every single time that the bulls push price action above this resistance level, the bears have regained momentum, created that lower low, and that's a higher probability that the bears are going to flow with the money. So they're looking for lower highs, they're looking for lower lows. Now something happened here. You got the lunar crash there. That completely wrecked everyone. When we say happy and sad, that was a sad day for most people, unfortunately. That was the lunar crash. You got the same with the FTX crash, but look what happened here. Price action's hit a level. It's hit a strong support, and now we've gone from the lower highs and lower lows to the sideways range. This sideways range creates a lot of indecision, and this is what I mean about the bottom of the range and the top of the range. Look how price has reacted at these levels, and from the bottom of the range to the top of the range, it is 86%. So if you're accumulating at the bottom, distributing at the top, this can be a powerful thing. That's 86% a move. So come back down, hit once, hit twice, 3 times, 4 times, and continues to hit it, as well as the resistance band at the top. So that's how you can trade sideways action. But what the psychology is behind the sideways action is there's a lot of indecision in the market. There's a lot of players doing exactly what I've just told you and positioning themselves. They're looking for lower levels. They're looking to accumulate at lower levels and to position themselves for the next run. So you can see what's happening every time you hit the support. You've got indecision. We've got these candles here. Let's read some of these candles here. You've got a bearish candle. The bulls have managed to push price action to the top of this extreme high of the session. Then the bears have pushed it back down. Then the bulls have opened, pushed price action back. Then the bears have pushed price action back. It's just choppy. If you enter in here and you've got your stop losses below there, stop before boom. And look where momentum lies here. You know, once you've got this kind of candle, there's the open, there's the close, straight through resistance, you know that something's changing. The bulls are regaining some form of momentum. Now, we're in this diagonal range on Dogecoin, and we've been in this range for some time. So let me calculate this, just so we know. The longer the time that you're in a range, the longer the resistance and support bands stick, and the higher probability that you're actually going to get a reaction at those support and resistance levels. Once something's broken out of a long-term range, you know that momentum's changing. So we've been in this range on Dogecoin for 572 days. That's over a year and a half. And then what happened here? The bulls and the bears are fighting at this resistance band. You've got the open, you've got the close. Then you've got the open, you've got the close. The bears have pushed price action. We were expecting it to be a rejection at resistance. You've got the wicks here, you've got the wicks here. This is our rejection band. We expected this to happen, but what we want is to create that higher low and to stay in trend. So this is our momentum line, this is our trend line, and this is our diagonal, which we'll go about in future videos. But what I'm saying is we need to create that higher low to regain that momentum. And once we've hit this trend line, this was a point where the bulls and the bears are fighting. And this is do or die for Dogecoin, but there's also a strong story behind this, because we've been talking about support, we've been talking about resistance, we've been talking about identifying that trend. When we know when we're creating lower highs and lower lows in a bearish trend, and higher highs and higher lows in a bullish trend. So let's analyze and see what we think from what we've discussed in this on this Dogecoin chart. So firstly, we've got this momentum line here. You've got a diagonal momentum line. However, this momentum line is a short-term momentum line. It's only held for, let's have a look. It's only held for 72 days in comparison to this one, which was 550 odd days. So this is the strong one, and this is the one we expect to have weight carried behind us. Now, it's all about knowing when you're right and knowing when you're wrong. It's all about applying the appropriate risk management. If you want to get wrecked in crypto, stick all your eggs in one basket, stick it in a high-risk meme coin, and then see how that does. However, if you understand how to read a price chart, understand how to read Japanese candlesticks, and understand support and resistance, you can get that edge in the market. I promise you that. So let's analyze as to what's happening in the short term here on Doge. So we've dropped the momentum line. We see here that the bears at this level here managed to completely wipe out the bulls, push it below this resistance band. Now, that's bearish short term. There's a few things that we need to happen here. We need to come back into trend, and we need to create a higher high. For the trend to continue, we need to create a higher high, and we need this to be a higher low. At the moment, it is a higher low. If it falls below this level here, this resistance band, it's likely that the trend is going to do something like this. Lower low, lower high at resistance, and then come back and test support. Now, are we looking for that trade? It hasn't happened yet. So we're looking to identify whether it is going to happen. We need to know when we're right, and we need to know when we're wrong. When are we right and when are we wrong on this one? What's happened? Bears in the short term regained momentum. It's come back down. Remember, this is 550 odd days or whatever it was. That's going to carry higher weight than the shorter term trend line. So we've come back down, and there's two things that's happened here. You've got buy orders at this support zone, and you've got buy orders at the diagonal. And you can see that's represented by this wick here. At some point, the bears have pushed price all the way to this support zone, and the bulls have pushed price action right back up to this body. And then we've got indecision. We've got this doji candle here. Remember, this is indecision. At some point, the bulls have pushed price action all the way here. Then the bears have pushed price action all the way here. And then you've finished in the middle, indecision. And then look what's happening here, indecision. Once you're at an indecision candle, once you're at support, and then once you get a candlestick that tells you that there's going to be a change in momentum, then that's a good entry order. As far as price action is concerned, as far as trading is concerned, you just need a few simple steps within your trading plan. A few simple steps you can follow. And one of those steps could be, what is my buy order? What do I need for a buy order? And one of those things can be, if you're at a strong support, that's carry and weight. If you've got double confluence at strong support, i.e. two levels of support in this case, diagonal and horizontal, that's adding as extra weight. Now, what we want next is something that looks like this. A bullish candle, which completely engulfs the extreme high of the previous candle and has got a strong body. Once you've got that, bulls are fighting again. The buy orders will start coming in, and then you can start testing these previous resistance levels to see how you can react until ultimately you're back in trend, and this acts as the lower high, and we continue to the upside. So subscribe to the channel, guys. I've nearly hit 5,000. I appreciate each and every single one of you. Now, if you want to use this in conjunction with an indicator to know if it's overbought or oversold, I've been shilling this video for the last few videos, but it is an important one, and you can use it in conjunction with what I've taught you today. It's the stochastic, RSI, and I'll leave a link in the video here. Take care and goodbye from me.